Hi there, it's Grant here and welcome back to the Fast Track Options Trading Challenge. Now in this video what I'm going to do is I'm going to show you how to open an options trade. Now if you've never traded options for the first time, this can be incredibly confusing and quite intimidating because there's so much you need to understand. Obviously you're going to need to know how to open the position, when to open the position and the whole rest of it. Now I'm not going to really sort of go into depths of how to pick a price, strike, and everything like that. I'm just really going to show you sort of really how to open a trade. Now, for this example, I'm using Tastyworks, which is one of the, in my opinion, one of the best options trading brokers and platforms out there. But if you're using a different platform to trade, such as Robinhood or another broker or platform, then everything you're going to see is going to be pretty much the same. There's going to be slight variations in how the information's displayed, but basically everything is going to be the same. So with that said, let's get on with it. Okay, so if you're using Tastyworks, or if you want to search for a stock, you just sort of enter it here. Just put, just say, let me just try and find Amazon. So if you want to look at Amazon or whatever, you can do it here. But just for this example, we're going to look at Google. And once you've done that, something called the option chain shows. So all of these dates here, here is basically it's basically the option chain, and all of these dates here are the expiration dates of the various options contracts that you can take. So let's just open a day. Let's say we choose, we want to choose an options sort of March 17th as the options date. So basically what shows here, these are all the different options you can get. So basically the strike price, and if you don't know what the strike price is, the strike price is the set price of the stock. You're taking the option out of that contract, you can buy that stock at. Now most of the time you're never going to buy the stock or sell the stock in the options contract, but this is basically the price it's the set price in the options contract that you're taking the option out on. Now basically on the left is going to be all of the call options contracts, and on the right are all the put options contracts. Now the numbers here is the premium you're going to pay, and this is very important to remember. When you buy or sell an options contract, this number here is the premium, which is the price. If we're buying a call, for example, this price here is the price you pay for one share in the options contract. Remember, in every options contract you take, it's controlling 100 shares. So whenever you buy or sell an option, always multiply this number by 100 to know how much money you're going to pay if you're buying a call or put, or how much money you're going to collect if you're selling a call or put. So this is the premium, the price you're either paying to open an options contract or the price you're paying to sell an options contract. Another important thing I want to say is, obviously another bit of confusion is, if I want to, what do I select? If I want to buy a call, buy a put, sell a call, sell a put. So if we want to buy a call, for example, if I want to buy the 86 call option for this stock, want to buy a call on it with an expiration date March 17th, 2023. All you do here, and basically this is your order. So this is basically what is displayed. I'm going to clear that. Now if you want to sort of sell a call option, you would click on bid. So just recap, if you want to buy a call option on a stock, click on the ask, which is the ask price here. Just clear that. If you want to sell a call option on that stock, you click on the bid, which is here. And it's exactly the same for the puts. If you want to buy a put option, you click the price on the ask. And if you want to sell the put option, you click on the bid. And you'll know basically if you're buying a call or put. If you're buying if you're selling a put or selling a call, there'll be a -1 there. If you're buying a call or buying a put, there's going to be just like positive number there. Okay, so let's just sort of have a look. So say, for example, we want to buy the 720, we want to buy the 87 call option for 720. So we like that. We think the stock's going to go up to sort of 80, say the stock's going to go, let's do the 91 because the stock's straight at 87. So if we expect, in the next, before March 17 for stocks to go up to 90. So what we'll do is we'll buy that and just click on that. And basically that is everything. So once you click that, you're going to have a number of contracts. Remember, you can have multiple contracts. If you want to increase the number of contracts, increase your position size on that play, you just hit this here. And then the number of contracts are going to increase. You can see we're buying a call because there's a C there. And basically, this is the limit price or the price we're going to pay. You can mess around with this if you want. You can change this. A lot of people also get confused about the order type. I'm not going to go into great detail. I would definitely set limit because the price you set here is the price you're going to pay. If you use market, then even though you put a price here, you can pretty much pay any price. So you always use limit price. I use day for TIF. What else to tell you? If you're not happy with the order, you can clear it here. And then, just sort of go here. So yeah, it's pretty much as simple as that. So the key things you want to know, really, you need to sort of remember is if you want to buy a call, go on the RASK and select the premium here. If you want to sell a call, go on the bid and just select your premium here and the strike, against the strike. If you want to buy a put, go on the RASK here, select your, select the strike and select your, this is your premium you're going to pay. If you want to sell a put, just go on the bid and just select the strike here, and this is the premium you're going to pay. So that is pretty much how you do it. Let me just show you again. So with this one, we're selecting to buy the 87 call. We're buying an 87 call with a strike of 7.15. We're taking out one contract with an expiration date of March 17th. We've got a limit price. We're going to be paying 7.15. If you're happy with all of that, you just click review and send. On the next page, you just finalize your order. Then you click send, and then the order will go and process it. And it is pretty much as easy as that. So I hope that's really clear for you. Just a few things I want to say. Obviously, the trading volume is quite important. Obviously, there's a lot of trading volume, on an option. That's usually a good sign. The delta is a very important. This is something called the Greeks. There's a couple of Greeks. The delta is the most important one. The delta really tells you of an options contract chance of success. So basically what this number means, 0.55 for every dollar the stock price increases, the value, the premium of this options contract is going to be rising by 55 cents. And basically with a call, the highest the delta can be is 1, and with a put, it's the opposite. The highest, or it's going to be in the opposite direction, is going to be -1. As we can see, they're all minus figures. So in many ways, this is the lower the delta, the less chance the option has of success. And obviously, the further out of the money you go, the lower, the delta is going to be. Obviously, these deltas are going to have a less chance of success. Couple of other things you need to know. A lot of people sort of think, well, where should I open my strike? when should I where should I base my strike price? As a general rule of thumb, you want to be opening your position, whether it's a call or put, within 10% of the strike price, which is in the money. You don't want to be going too far out of the money. Now, the further, depending on whether you're getting a call or put, the further out of the money you go, yes, the cheaper the option's going to be, but the more risky the trade is, because obviously the further out of the money you go, the more that stock price has got to go before basically you can start turning a profit. So as a general rule of thumb, you want to keep your strike price within about 10% of in the money, because basically the closer you are to the money, I guess, the more chance you have of success, because the stock's got to move less far in order to get in the money. And obviously if you want a call, you want the stock to rise above your strike price. If you're buying a put, you want the strike, the stock's price to be lower than the strike price in the contract that you're buying. So that's very important to remember. So if you're sort of thinking, well, where should I open my position size? Try and aim within 10% of the in the money sort of line here. And that is basically, on a very basic level, how you open an options trade. Obviously, I'm using Tastyworks, but it's going to be a similar process if you're using another platform. So I really hope you found this video useful and it was clear for you. If you've got any questions, please leave them in the comments below. If you like the video, please like it, because it will help this video to reach more people. If you want more content like this, why not subscribe? Before I go, obviously before I go, I just want to let you know, if you're starting out options trading, one of the hardest things is knowing which stocks to pick and how to, which positions you want to open. That's why I always recommend, when you're getting going, it's best to join an option service that gives you solid trades that you can follow along, especially if the traders are really, really good. And what I'm going to do is I'm going to link down below to my favorite options trading service, which is called One Ticker Trade. It's run by Larry Benedict and his team. Larry's one of the leading options trading experts in the world. And since he opened his service, which was August this year, he is on a 10 trade winning run. And him and his team put out a number of different options trades every month, and you follow along. Service is only $19 to join, and that will lock your membership in for a year, and also you get a 60-day money back guarantee. So if you want to try that and take all of the guessworks out of which options trades to pick, click the button, or I'll put the link to it down below. Click the link, have a look, and why not join? It's only $19 for the year, and you get a money back guarantee below as well. So anyway, thank you very much for joining me. I really hope you found the video useful, and I'll speak to you